Every year, business owners scramble in late December hoping there's a magic deduction left. The truth, there are still some legitimate IRS-approved strategies available, but only if you act before the calendar flips. Today's episode is going to give you 7 strategies to take advantage of before the new year hits. Hey, my name is Stephen Young with the Savvy or Surrender podcast, and I would love it if you would just take a quick second to subscribe. If you're watching on YouTube, hit that like button, hit the subscribe button, Apple Podcasts or Spotify or anywhere you find your podcasts. If you could download the episode, if you could give us a comment, I would greatly appreciate it. You can always go to savvyorsurrender.com as well. So today's episode, no fluff. We're going to really get into it. No theory here. I'm going to give you some specific examples of things that you maybe should be doing in your business. These are moves that require action now. So if this isn't December when you're listening to this, when I'm putting this out, then just think about these moves for this calendar year that you're listening to this. Who knows? You might be listening to this in 2050 and I'm already gone, sailing the sunsets in heaven. 2050, 25 years from now, 77. Hopefully I'm still around. I don't know. Anyways, I digress. Let's get into this and make sure that you're not missing these moves. Move number 1, accelerate legitimate expenses. If it's ordinary and necessary and paid before December 31st, we can usually get it to count, especially if you are on a cash basis. So what do I mean by that? Examples are things like supplies, repairs, software subscriptions, professional fees, accounting fees. If you want to pay your bookkeeper or your tax preparer in advance, you can do that. Marketing, insurance premiums. If you want to pay annually on your insurance premiums and do it before the end of the year, you can do that as well. Especially, again, if you're a cash basis, because cash basis means whatever cash comes in, you have to recognize. Whatever cash goes out, you also recognize. So you're not having to go and do prepaid stuff. Reminder is that acceleration is not the same as buying junk you don't need, which is where I often come to people and I say, they'll tell me that their tax professional told them to buy a car. Well, if that's your best option, then I guess maybe that's what you do. But to me, that is the last thing I'm ever going to tell you is to buy a car. If you need it, fine. If it's going to help your business, fine. If it's going to help you grow, fine. I have told clients to do that. I'm not going to say that I haven't, but only because they were going to need it in the new year. If it's just something to try to get the write-off, it's dumb in my opinion, because now you got 5, 6, 7 years of payments. You buy a $100,000 F-350 for your concrete business, and now you've got payments for the next 6 years of $1,000+ a month, and all because you wanted to take a quick deduction this year. Just doesn't make sense. What are you going to do next year? Now, move number 2 is equipment and vehicle purchases. Now, again, we were just talking about the vehicle, right? But there's also other equipment that maybe you might need in your business, depending on what it is you have, what kind of business you are. But so any kind of machinery, tools, equipment, the key is it must be placed in service by December 31st. So if you're trying to buy a skid steer now, they probably don't have them. In fact, I have a client who sells for Caterpillar, and December is his busiest month because everybody's trying to get equipment in before the end of the year. It has to be placed in service, so you have to take delivery of it, ready and available for use, not sitting in an unused in a box, especially if it's at the warehouse or whatever. It's got to be ready to go. And this is really where Section 179 and bonus depreciation come into play. These are great plays for that. And the One Big Beautiful Bill just increased bonus depreciation. It would have been 40% this year. Instead, we're getting 100% as long as you bought it after January 19th, 2025. So we're good there. All right, move number 3. We're moving along here on these. Retirement contributions. Some of the biggest tax savings are still available late in the year using retirement savings accounts. Now, I want to make sure that this is probably the biggest, the best opportunity that you can have in your business. every year we go into business and we don't want to pay taxes, right? We don't want to pay Uncle Sam. So we try to, and I'll have clients come to me and they'll say, hey, how do I get to zero? How do I pay zero taxes? Which essentially means you need to show no income, right? That's what we're doing. And so to do that, we try to find these deductions and these expenses that we can do in advance to show no income to then lower our tax bill. But then all we're doing is starting over broke the next year. And I'm not saying that's not the way to do it all the time, and maybe some of the time, and maybe in the beginning of your business. But ultimately, if we want to get ahead, if we want to play real money, if we want to play real wealth, the opportunity there is not in getting the deductions down to zero. The opportunity there is to find ways to save money and pay as little taxes on it as possible, to then continue to grow your net worth, to grow your business. Now, that may mean moving from an S-Corp to a C-Corp when you're ready. There may be strategies in place there, especially if you already have another 401k from an old job or something like that. Using something like a Rob's loan might make sense for you with a C-Corp, and there's some serious plays there. But if not, if you're just an S-Corp right now, or maybe you're just a sole proprietor starting out, that's okay. There are some phenomenal retirement plans that the government gives us to help us get ahead better. Things like a solo, or basically is called a solo 401k. If you don't have any employees, or your employees are only part-time employees, you can have a solo 401k. You can get that set up. So let's say you're an S-Corp owner and you pay yourself a salary of $60,000, $70,000. You can contribute up to $70,000 in a solo 401k. Between a Roth and a self-directed and the 401k, you can have a lot of money moved into there and be able to save all of that money and move it over. Or we also have the HSAs, the health savings accounts, that required before you had to have a high deductible health plan, and it had to be really high deductible, and not everybody was able to qualify. Well, with the One Big Beautiful Bill, one of the changes that was made that wasn't really advertised very well was the HSAs now qualify for all bronze plans. So if you're using Obamacare and the bronze plans, that now qualifies. I had a bronze plan, but I was on a plan that still said it was non-HSA. Well, guess what? Now I get to do it. So I get to use the HSA finally. $8,500 for a family. That's a lot of money that I can defer, and you don't have to use it. Here's the real play with an HSA. You don't actually use it for your medical expenses. You hold on to that money for later on in life. You still pay your medical expenses out of pocket. And the other change with the One Big Beautiful Bill, and this is beautiful, and I think a lot of people miss this one too, is if you have one of the doctor direct care policies, or doctor direct care and an HSA. So maybe you're using not an HSA, but a high deductible health plan. So maybe you have a really large, really high deductible for just catastrophe or catastrophic care only. And then you have a doctor plan that you pay $100 a month for, $198 a month for the family. I know there's a couple clinics out here that do it. They have a doctor on call. You can get in really quickly. But basically, it's a membership or a subscription plan. And you go in every month, you pay that, right? Kind of like your health insurance, but it's only a couple $100 a month, and your whole family gets in there, and everything's covered. That didn't used to qualify for an HSA. Well, now you can have one of those, have a catastrophic plan for the higher medical stuff, for the big stuff, for the emergency stuff that you hope never have to use. And then you have an HSA plan that's helping you to save your money and move it into the future and be able to have it all tax written off. Those are the kind of plays that you need to be looking at to be able to really increase your wealth, okay? All right, and there's also SEP IRAs, simple IRAs. I'm not a licensed financial person. Talk to your financial advisor, but look into self-directed plans as well. You want to trade in crypto tax-free, go to taxfreecrypto.com, and you can start trading crypto without having to worry about taxes at the end of the year. Move number 4 is to pay yourself, and the timing of it. And this goes into the retirement accounts as well. So as an S-Corp owner, if you're an S-Corp owner now, make sure you're paying yourself a reasonable salary. What does that reasonable salary what does that mean exactly? The IRS does not define it. We've talked about this in past episodes, how to back into your reasonable salary. Now, if you are a therapist, I was just talking to a therapist client of mine yesterday, and he's working 40 hours as a therapist, billing at $200 an hour, he's going to have a hard time showing his reasonable salary, anything less than what that is, right? 40 times $200 an hour or whatever. But he doesn't, right? He's in therapy 20 hours a week, but he's got admin time. He's got billing thing. He's on the phone with the insurance companies. He's doing other things that are $20 an hour. So look at what your week really consists of. Just take it as a 40-hour week, which I know is a joke. Most business owners don't work 40 hours, but let's look at that and really figure out what your week consists of. Are you going to networking meetings and other marketing type things? Are you on the phone? Are you doing admin stuff? Are you doing things that are less than what a job of the CEO would get paid? Figure that out, and that's where your reasonable salary can come in. Make sure that your payroll is paid by the end of the year. If you're trying to go and get it reported by the January 31st for your payroll taxes with your federal 941, you got to make sure that the payroll is all done and taxes are correctly taken out by December 31st. And also bonuses, of course, make sure they're all ran through by December 31st. Waiting until January can really cost you on some of these deductions. All right, move number 5 is one of my favorite ones and probably one of the least known, and that is the accountable plan setup. And this one you don't want to miss. It's one of the most missed year-end strategies, I think. This allows for reimbursement of your home office, mileage, phone, internet, tools, all those things that you think, well, yeah, Stephen, I deduct those on my business. Maybe you do. Maybe you're buying things for, you're under your personal account and you're not even thinking about it, or your home office when you're an S-Corp, just get to write it off kind of the same way as you did with an LLC or a sole proprietor. So you want to have it set up by the end of the year. And even if the reimbursements happen later, we want to make sure we get this set up. An accountable plan is how you turn expenses you're already paying personally into tax-free reimbursements and legitimate business deductions without triggering any payroll tax. This isn't a loophole. This is actually written in the tax code for decades, just most business owners never use it. So the purpose of this is to move everyday business expenses out of your personal pocket and into your business without paying any payroll tax, income tax, double taxation, anything like that. It's essentially like if you were an employee and you had an expense account. It's the same thing, but now you're the owner of the business. So reimbursements must be treated as, or normally without an accountable plan, reimbursements have to be treated as taxable income. So we want to make sure we have this written into your business operating agreement. And so and then if you don't have it written out or reimbursed at all, then a lot of times you just eat the cost of it and you don't even think about it. You're missing opportunities and deductions here. So the business will reimburse you. The reimbursement is not taxable to you, and the business gets the deduction. So everybody wins except for the IRS, right? So here's why this can be huge, especially for my contractors. When you're paying for businesses personally, home office, cell phone, maybe you're on a cell phone plan, your wife just pays the bill, you don't even think about it. What's your portion of it that you're paying, that you're using towards the business? Internet, mileage, tools, any supplies, equipment storage, business use of a personal vehicle. Without an accountable plan, these costs often go unreimbursed, get deducted incorrectly. They trigger an audit risk if you're trying to do it on the business plan and it's done incorrectly. And then again, they could get missed entirely. So an accountable plan will completely fix that. So here's what you do. You want to make sure that when you experience this business expense, that you're documenting it. Receipts, mileage log, usage percentage, if it's your personal vehicle. You want to submit it to the business. You get the receipts. You create maybe an Excel document and you have a form, an expense reimbursement form. The business then reimburses you. They put it into your paycheck. They write you a separate check, whatever it is. It's tax-free to you. It's deductible to the business, and it's not subject to payroll taxes. So here's an example with a contractor of mine. We figured out his home office costs were $6,000 per year. His cell phone and internet, another $2,400 a year. Mileage reimbursement, $5,000. Without an accountable plan, these are either not deducted correctly or they ended up getting buried, like the internet. He didn't even think about his home internet. He's at home, he's doing work, his internet gets reimbursed there. Not the whole thing, but for the business percentage. Business reimbursed my client $13,400. He paid zero income tax on that, zero payroll tax on that, and the S-Corp gets to deduct the full amount. So that's $13,000, $13,400 in real savings. Now, is that, if you've got $500,000 sitting there, is that going to do a whole lot? No, but everything counts as you get it and you add it up. And these aren't expenses where we're trying to go down to zero, like I was talking about with the retirement plans. These are expenses that are already happening anyways. That's the key, is to find the expenses that are already happening anyways and just make sure we're capturing them. So we want to make sure it's set up by the end of the year, because the accountable plan must be formally adopted before the expenses are incurred, which means, as I mentioned before, you need to write it out, you need to create it and put it in your operating agreement. Now, even if you don't have, some people have, it used to be much more common, but you'd have this like folder, the binder in your bookcase, right? And it would just sit there and it would collect dust, kind of like your OSHA safety plan, you'd pull it out when the OSHA safety guy would show up, and you'd show it to him and you say, yeah, sure, I have this safety plan. Never looked at it, don't know what's in it, but it's there. So with your operating agreement, you can have a folder, create a Google Drive, or if you have a Google Drive probably from your email or something, just create a folder that says operating agreement or corporate documents or whatever it is, and have your information in there, your articles of corporation, your operating agreement, your business meeting minutes. Have business meeting minutes for every month and just title it December 2026 or December 2025. I'm a year ahead. January 2026. Put your minutes in there of what you did, what you met, where you met, how much that dinner cost you, or how much that hotel cost you to be able to have that board meeting. Did you catch that? There you go. You can go and have board meetings in places that you're going to travel to during the holiday. That's a free bonus one. That's not even a move here in the show. All right, so you get all your reimburses expensed. Even back in January, February, you want to count it all by the end of the year. That way you don't lose the deductions. So you want to make sure you get this done by December 31st. Again, the IRS is going to require a valid accountable plan. It's got to be written. It's got to have required receipts and logs, expense reimbursements. You want to make sure you're documenting these things. And that's the key, because if they do ever come to you in the event of an audit or they send you a letter and they say, hey, we're challenging some of these items, you want to be able to show that you have all of these things in place. Move number 6 is to harvest your losses and clean up your books. What does that mean? It means if you have aged receivables. I was looking at some clients' books the last week, and they had aged receivables that were well over 180 days. They weren't going to collect it. They knew they weren't going to collect it. Get it off the books. Go ahead and write it off as bad debt. If you have old inventory, either find a way to sell it, give it away, dispose of it, whatever, clean it off the books. If you've got that inventory on the books and it's never going to move, that's hurting your ratio numbers to be able to get any kind of lines of credit. So if you're in a business where you need lines of credit to be able to get you through those slower months, especially if you have, maybe you're a retail store and you've got Christmas inventory and things like that, you want to be able to move that obsolete inventory off of your books so that your ratio is looking better. Preferably you sell it for something, but even if you don't do that, at least you're able to get it off of the books. Clean up your loan balances. Make sure that you're taking the interest on there and you've got that showing up, your depreciation. Make sure whatever your tax guy did last year is being accounted for in your bookkeepers. In your bookkeeping, if the bookkeeper and the tax person are two separate people, let's make sure they're talking together and they're making those adjustments so that your books are accurate. This will help protect your deductions, any audit risk, and of course, just have accurate books so that at the end of the year, you should be looking at your financials. You should be looking at your financials pretty much all the time, at least monthly. But look at it at the end of the year and know What does it say on the profit and loss statement? What does it say on the balance sheet? Your statement of cash flows. We can go over one of those later on in the beginning of the year. I'm planning on, that sounded kind of funny, huh? And later on in the beginning of the year, but here it is. We're in the middle of December. So beginning of the year, we're going to have some episodes where we're actually going to go into the financial statements, and so that you can understand those. So look for a future episode with that. Okay, move number 7. Here's another big one that I want to get into, and that's state and local taxes, SALT. Now, the One Big Beautiful Bill gave us, SALT used to be at $40,000, which meant any state taxes that you paid, property taxes that you paid, any local taxes that you paid, if you have any of those. When you paid those, we used to be able to write them off on the federal tax return up to $40,000. And then that went away with the Tax Cuts and Jobs Act in 2017 down to $10,000. Now, it didn't matter for a lot of people because the standard deduction went up so much that they weren't even taking SALT anymore. They were just doing the standard deduction. Unless you were a really high income earner, you had a really expensive house, but even that was capped at $750,000. So there were all these different things that you had to look at where SALT wasn't as big of a deal. Well, the One Big Beautiful Bill increased SALT back to $40,000. And where this really affects is business owners, of course. So when the Tax Cuts and Jobs Act kicked it down to $10,000, what a lot of states did was they created what was called PTET. And so with PTET, they wanted to make sure that you were able to capture your taxes and be able to pay them at the business level for your state taxes specifically, and then you would be able to write them off on your, so let's say your S-Corp, you'd write off your state taxes that you would have due personally on your S-Corp, on that return instead. And so you were kind of paying them instead of putting it on your personal return. And instead of having to claim and itemize your deductions, and instead of getting stuck at the $10,000, you were able to then go and pay it at the business level and have that be a write-off. So this can dramatically reduce your federal income tax, because if you were making $200,000 and you go and you write off your state income tax, let's say it's $12,000. Now, all of a sudden, you're able to, your federal income tax or your net income has gone down, and you don't have to worry about whether or not you're itemizing or anything like that. So let's look through a quick scenario here where I'm actually going to go to the board for the first time here in my young podcast career. I've been wanting to do this. Let's say that we have a state income tax, or I'm sorry, a S-Corp taxable income of $200,000. So we write here, if I can get the pen to work, we have $200,000. And we have in Idaho, I'm just going to use Idaho's tax rate. Everybody's tax rate is different. And the one thing about your S-Corp tax return is every state is different. So not every state decided to do this with the PTET. So first of all, there's like 30 states that said that they would do it, including, believe it or not, California is one of the ways that you can do it. So you want to be able to look at that and see, does this even work in my state? And then you figure out, what is your state tax? What are you going to owe? So if your taxable income is $200,000, you figure you have a tax rate of 6%, that's $12,000 in state income tax that we're going to have to pay. Now, if you're not itemizing, let's say maybe you don't itemize normally, and because even if you pay state income tax of $12,000, let's increase your property taxes. Let's say that's another $3,000, so that's $15,000. Well, if you're married, your standard deduction is over $30,000. You're probably, unless your mortgage interest is really high, you're probably still not itemizing. I would say out of all the tax returns I did last year, less than 10% itemized. Most of them still just took the standard deduction. So here's a way where we can actually get the standard deduction and be able to pay our state taxes. So this $12,000 that we're going to pay that through the S-Corp. We're going to deduct it off of the net income. So now instead of $200,000, we're only going to have $188,000 of income that we're going to show on the federal income tax return on our 1040. First on the 1120S with the S-Corp, and then down to the 1040 off of our K1. So because the owner doesn't itemize, that's $12,000 that's normally not deductible at all. The SALT cap doesn't even matter here. It's just simply lost. But with the federal income, it would stay $200,000. So now you're paying $200,000 at, let's say, a 20% tax rate, 24% tax rate, whatever it might be. So when we go and we do this, the business, again, is going to pay the $12,000 instead of the owner. The business gets to deduct the PTET payment. The $12,000 becomes a business expense on the S-Corp return. So your new federal taxable income is going to be, like I said, $188,000. Your owner gets a state tax credit on your owner. The owner gets a state tax credit on the personal return. The owner receives $12,000 state tax credit. So there's an election that your tax professional pays on the tax professional has a box that they check off that says that they chose PTET. Now, again, if the owner is going to just take the standard deduction because the state tax was paid at the entity level, they can take the full standard deduction and get the benefit of deducting the state tax directly off of the business with the PTET. And I apologize, I don't think I ever said it, but PTET stands for pass-through entity tax. So that means like your S-Corp or your LLC, where the business has a state tax, or the business is generating all of the income, but all of the taxes and everything just passes through to the business owner. So not a C-Corp. A C-Corp has its own tax, but everything else is considered a pass-through entity. So that's where the states created this, to be able to help you pay off those taxes at the business level. But you have to know about this. You have to check off the box. So if somebody's making $200,000, let's look at what the actual savings could be here. If we have the PTET deduction of $12,000, and let's say because we're at the $200,000 income level, we're bumped into that 24% bracket. So if we have $12,000 times the 24% bracket is going to equal $2,880. That's $2,880 that you just saved paying the exact same sales estate tax. You just lowered your federal income tax, and you get to still take the standard deduction. So right away, we just saved almost $3,000 just by using the pass-through entity tax. We didn't do anything different. And the great thing is when the states came up with this, the IRS approved it. They were good with it. So this is definitely something you want to talk to your tax professional about, and moving that state tax into the S-Corp, have them pay it. So PTET, pass-through entity tax, lets the S-Corp owners deduct state taxes at the business level, even if they take the standard deduction personally. Okay, so what's next? We want to make sure also that, as I said, PTET does not replace the federal estimated taxes that we talked about last episode, getting into the federal estimated taxes that are going to be due January 15th. So it doesn't replace any of those, of course, but it could potentially lower it. All right, let me give you a couple of bonus moves. Charitable giving, if you do it the right way. Normally that still flows through down from the personal or into the personal return, but you can still go and donate at the business level, especially if it's things like equipment, stuff like that. You just want to make sure it's documented, valued correctly, and that the qualified organization gives you some type of receipt. No receipts, no deduction. And if you're in Idaho, if you happen to be one of my Idahoans that are listening, thank you very much. Appreciate you. Make sure that you donate something to the Idaho Youth Ranch, because the Idaho Youth Ranch, it gives you a $250 credit, or up to a $250 credit on the state tax return. So donate to the Idaho Youth Ranch. It's just one of those things. The tax professional needs to make sure that they check off the correct box, put in the value, you get up to $250. All right, with that, what is the biggest year-end mistake? It's waiting. Tax planning rewards early action, not planning, or not panic. Tax planning rewards early action, not panic. So what do? You go to meetwithsavvy.com and you schedule a discovery call meeting with me and my team to make sure that we are helping you take advantage of all of these moves before the end of the year. Again, please subscribe. This guy right here, subscribe to me. I got it right. I did the right button, or the right hand. Subscribe and like this video. I would greatly appreciate it if you found this information to be helpful. And with that, I will talk to you on the next episode.